Have you ever thought, why wait until I'm gone to help my kids? As a mother of 4, this is something I often ponder about. Maybe you want to help them with a home, with a down payment, pay off some student debt, or give them a head start. This is called an early inheritance. Gifting your children or grandchildren money or assets while you're still alive. But what does that mean financially? Are there tax consequences, legal pitfalls, and is it always a good idea? Let's walk through how early inheritance works in Canada and what you need to consider before gifting. Hi, I am Sally, a licensed financial advisor. Let's get started. What is early inheritance? An early inheritance is simply giving your children a part of their future inheritance now, instead of waiting until your will is executed. It might look like a cash gift for a home purchase, transferring ownership of a cottage, giving investment like stocks or mutual funds, helping with tuition, wedding costs, or starting a business. It's often done from a place of love, and while it feels simple, there are a few important things to know, especially about taxes and fairness. Part 2, are gifts taxable in Canada? Let's start with one of the most important questions I get. If I give my child $50,000, do they have to pay tax on it? The short answer is not in Canada. We don't have a formal gift tax or inheritance tax like in the US, but the gifter might trigger taxes depending on what you're giving. Let's break that down by the type of gift so you know what to expect. Cash gift, the simple case. If you're giving your child cash from your regular bank account, there's usually no tax consequence on that for them. From a TFSA, no tax on the withdrawal and no tax for your child. Just a reminder, TFSA room is only regained the following calendar year from an RRSP or RRIF. That's different. Withdrawal from registered accounts are fully taxable to you as income in the year you withdraw it. For example, withdrawing $40,000 from an RRIF to give your son. That $40,000 is added to your taxable income and could bump you up into a higher tax bracket this year. Gifting property, a hidden tax hit. If you're giving away a property, like a second home, a cottage, or a rental, CRA considers that you sold that property at fair market value when you gave it away, even if you gave it away for free. This means you must report the capital gains on your tax return. If it is a rental, you might also owe recapture tax on any depreciation previously claimed. For example, you bought a cottage for $200,000 and now it's worth $600,000. If you give it to your daughter, you'll owe tax on the $400,000 worth of capital gains, even if no cash changes hands. The only exception is if this is your principal residence, then it likely qualifies for the principal residence exemption, and that shelters you from paying capital gains. Gifting investments, stocks, mutual funds, and ETFs. When you give non-registered investments like stock or mutual funds, the CRA again assumes that you dispose them at market value. This means you will trigger capital gains or capital losses on the appreciation. 50% of the gain is taxable to you. For example, if you gave your child $50,000 worth of stocks that you bought for $20,000, you will be taxed for the $30,000 gain. And that $15,000, half of the $30,000, will be added to your income for tax purposes. A reminder, this rule applies even if no money is exchanged. A gift is still considered a deemed disposition. Gifting to minor children, the attribution rule. When you give income-producing assets to a child under 18, it triggers a special tax rule. Any interest or dividend income from the gift is attributed back to you and must be reported on your tax return. Capital gains, however, are taxed in your child's hands. This means giving a GIC or a dividend-paying stock to a 12-year-old, you still get taxed on the income. This prevents parents from something called income splitting with their kids using gifts. Joint ownership risk. Many parents think, oh, I'll just add my child's name to my house or bank account to make things easier, and add their child to the bank account, property title, or investment account. But joint ownership could trigger capital gains, estate disputes, and even creditor exposure if it's done incorrectly. CRA may treat this as a 50% deemed disposition. It could expose your assets to your child's divorce or debt situation, and if unclear, it may spark legal challenges from other heirs after your death. For best practices, speak to your lawyer and financial advisor before using joint ownership as a shortcut for gifting. Document everything. Whether you're giving $5,000 or $500,000, document it. Here is why. Create a gift letter, especially if your child is using it for a home purchase. Lenders and mortgages often require this. Keep a paper trail. How much, to whom, when, and for what purpose. Update your will to reflect whether this is a gift in advance on their inheritance or a separate gift. Talk to your advisor about whether the gift should be outright or through a trust for added control. For large or complex gifts, consider using a trust to outline when and how the money can be used. Common mistakes to avoid. Even with good intentions, people can trip up. Here are 5 common mistakes to avoid. 1. Gifting too early and then falling short in retirement yourself. Not communicating clearly and leading to resentment between siblings. Professional advice. Forgetting to update your will after giving a large gift. Gifting to a married child without safeguards. This can be putting your money at risk in case of a divorce. And these aren't rare cases. A little planning goes a long way. Early inheritance isn't just about the money. It's about impact. It's about helping your children when they need it most. It's about sharing not just what you've earned, but what you've learned. But like any meaningful decisions, it deserves careful thought. When you give with clarity, intention, and advice, you're not just gifting a gift. You're shaping your legacy. So take the time, ask the right questions, and get the right support. Work with a financial planner, tax expert, and estate lawyer, because when you plan well, you get to watch your gift make a difference without regrets, confusion, or conflict. If you have questions or want help reviewing your plan, feel free to reach out for a free consultation. Details are in the description box below. We're on a journey to building a community of money-smart individuals. Please like, share, and subscribe, and I'll see you next time.